All right. So all you need to do is just to know how the market moves, and I'm going to show you how the markets move just now. Now I'll use a description. The market uses candle. This is the candles. These are the
Agwụgwụ na-abịa
these
mbọ.
are the candles. This is the up candle, and this black one is the down candle. You see the black one coming down. This is the down candle. This white one or the gray one here is the up candle. So that is how market move, and market move up and down. So please I will also want you to, if you have the means, you can also write down one or two things. Though this video will be recorded and uploaded on YouTube, but you can still jot down one or two things in case of anything.
I put my phone on screen record, so after I can still
All
check.
right. All right, so let me use a paper, let me use a textbook diagram for you before we go deep into. So today we are going to be looking at market structure. What is market structure? Market structure is just basically how the how forex moves, how the market chart move. And basically this is how market moves. Market just go up, come down, it moves in zigzag form, it goes up again, it goes up again, and it comes down again. So that's how market move, right? So if market is going up from here, from this point here, if market is moving from this point, this is the low here, and this is the high of this point, just as this is called the uptrend.
Yeah.
This is called the uptrend or bullish trend. So this is the uptrend or bullish trends. And when it's making this up, down, up, down, up, down. If you notice very well, there's what we call break of market structure. When market is moving from this low point and going up, it will come down and it will go up again. Now this point where market stopped from going up is what is called the break of structure. So this right here is known as the break of structure, which I will signify by BOS. Sorry. Let me admit the other person. I think the person is on now. All right. Okay. Welcome. Welcome, and just we have already started. So just um, just follow up as we continue. I was just telling, I've not really gone far, and I'm also recording this session right now. I'm going to upload it on my YouTube, and maybe later you go back to watch. So we are talking about the bullish trend or the uptrend, and we are talking about market structure. Market structure is the movement of market. And how does market move? Market moves from down to low if we are talking about the bullish structure, or from low or from high to low. All right. So this will be our bearish trend.
Ọ na-ama afọrọ ya, ọ ga-akọ ọsọ afọ nsogbu ga-adịba
Sorry. So this will be our bearish trend. This is called the downtrend,
abụzi anya so maka aka mma ihe
down or bearish trend. I hope you can see my screen.
Yeah, same.
Okay. So when market is going the on the uptrend or the bullish trend, we can see that market goes from lower low to lower high. That's just the basic interpretation. Market moves from lower low to lower high, lower low to lower high, lower low to lower high. And as the market is moving, as price is moving from lower low to lower high, price is creating a break of structure. Now this is the first break of structure, and I'm going to signify it by, you know, sorry, I don't know why this. Okay, let me just I'll just say this is the break of structure. This is the first break of structure, and this is the second break of structure. This is the second one. So at each point that market is breaking structure, we see that if market breaks a structure, as market has broken this first structure, market will come down, mitigate either any zone around this break of structure. Now let me just show you something. So when market breaks structure, here will now be the low of that structure, and this highest point will be the high of the structure for the bullish trend, right? So when market creates that high, market will come down to mitigate either 50% between this break of structure or almost at the last point before it will continue its up move, bullish move. All right, so now this is just basically it. This is just movement of market structure. Market can move up and market can move down, causing break of structure as it moves up. And I am an intraday trader, which means I trade only during the, after the close of business day for that day. I don't hold my trades, I close my trade and I move on. There are different types of traders. There are scalpers, there are intraday traders, and there are people that hold trade for like for a week or for even months. But me, I don't do that. I hold trades between days. I can hold my trade highest maybe one day, 2 days highest, and I'll close the trade. And that's how I trade. So this is all you just need to know: market movement. Now the next thing I'm going to be talking about, because I want to make this training a very this training I want to make it a very short and precise training, so that it will be easy for you to understand. I don't want to make it very long. So just know this: when market is bullish, market will be breaking structure upwards, and when market is bearish, market will be breaking structure downwards. I'm going to show you on the charts, right? I'm going to show you. I'm just drawing this for you to just, look at the paper explanation of it, or the textbook explanation of it, right? Well, so when market is coming down too, market will be breaking structures downwards, right? This is the break of structure downwards, right? So this is the break of structure downward, and this is the break of structure upward. Like I said, market will go up and break structure, come down and break another structure for a bullish trend, but for a bearish trend to go from higher higher high, I mean lower higher low to lower low, higher low to lower low, higher low to lower low. I won't be using some grammars because you don't even need all those grammars for trading. You just need to know market structure, and the next thing you need to know is supply and demand zone. Supply and demand zone. Now, for a bullish supply zone, for a bullish demand zone, if market is, bullish, going up like this, up down, a demand zone is the last bearish candle. What is a bearish candle? Let me show you example of a bearish candle. Let me open another this thing, so that I will not go out of that place. All right. I'll use this. Let me use this as an example and use this as an example. All right. Now, like what I was telling you. Okay, let me use 30 minutes. Let me just use 30 minutes and explain. This is what I was just showing you in this side, right? In this side, market moves up and down. So let us look at the bullish side. You see how market came down here. This is the price candle. This is price candle. Price came down, went up here, came down again, went up, broke structure here. You see how market broke structure? Let me just label it as break of structure so that you will see it. Breaks of, don't worry about, just follow my mouse as I explain. These are trades I took, right? So let me just delete this. We'll come back to how to take trades and everything, but it might not be today because we're just looking at structure, market structure, supply and demand zone. Now you see how market broke structure. So when market broke this structure here, then this zone here, the last bearish zone at the lower time frame would be your demand zone. What is it called? Let me show you how to locate it. A bearish candle is a candle that is going down, right? A candle that is going down, while a bullish candle is a candle that is going up. And how for you to know a bearish candle, like for me now, I've changed my candles to gray and black, right? Gray and black. So for me now, the black candles are the bearish candles. You see these big large candles here, these are the bearish candles. You see the gray candles here, these are the bullish candles. Now for you to know your demand zone for a bullish market is the last bearish candle. Let me zoom in. Let me zoom in for you to see. See this last black candle here before price started going up to this point? That is your demand zone. That is your demand zone. And what does a demand zone do, or a supply zone? After a break of structure, a demand zone is a zone that is known to not to fail. Like that zone is a place that market will come to and market will not have to go beyond that point. You understand? Market would not go beyond that point. So that is a demand zone. Even a supply zone too, it's also a zone where it's expected that market should not go beyond a supply zone or a demand zone. Now this bearish candle is our demand candle. I hope you're following.
Yeah, I'm following. I'm following.
Okay, so this candle here, this candle is the demand our demand candle on the 30 minutes time frame. This our 30 minutes time frame. So we are using demand candle of 30 minutes time frame. So just like I'm saying, after every break of structure, a demand zone is formed for a bullish trend. For a bullish trend, a demand zone is formed for a bullish trend. So after market broke this structure here, just like we saw here, after market go up, come down, break structure, a demand zone is formed, and that demand zone is the last what? Bearish candle. That is what we are seeing here. This last bearish candle, market have gone up, come down, broken structure, and this is now our demand zone. So it is expected that price, market or candle or price, whatever you want to call it, as price has gone up like this, came down like this, and broke structure like this. So it is expected that this price or the candle movement should not come below this point again, should not go below this low here or below this low here, because this is the demand zone. So if price goes below this low, it shows that this demand zone is not a strong demand zone, and probably price is no longer going up, so price has started coming down. But then price, if you look at what happened here, price did not go below this low here, below this candle here. Price stopped somewhere here and started going up again, and price went up. So this is just it. So price went up again to this point, came down to this point, and went up again. So that is price movement for you, and that's what I'm trying to tell you here. That when price is bullish, price is not supposed to go below that demand zone. So after every break of structure, there should be a demand zone, and after every break of structure to the downside for a bearish trend, there should be a supply zone. So demand zone is for what? Is for bullish trend, while supply zone is for bearish trend. So and supply zone is the last bullish candle that is found here. And let me show you an example of a supply candle. Now if you look at here, if you look at this plate, market started doing this reaction. Market was coming like this, came down, went up, and broke this structure here. That's why I marked it as break of structure. This is where I mark my break of structure. So I marked it as break of structure. Market did this again. Market went up again. You see that market did not pass. What did I tell you? Now this last, let me just delete this so that you see properly. Let me delete everything here. So I was just making some markups. So this is the bullish candle for our supply candle. This is this bullish candle. I'll make it large for you to see. That's the bullish candle, right? But we are going to mark it all the way to the top here. Let me expand it so that you will see it properly. All right. So if you can see, can you hear me? Ongozi, can you hear me? Just say yes, you can hear me so that I'll continue. Okay. I can see that. Thank you very much. So this is the for supply zone. Let me mark this as supply zone. This is the supply zone. So it is expected that price should not pass this place after every break of structure to the downside. When price is going down, when price is bearish, it is expected that price will not pass this bullish candle, this last bullish candle that caused the break of structure. Price will not pass it. And if you look carefully here, price did not pass it. So price only did this. Price came down, created the supply zone, right? Came down, broke structure to this point, went up a little bit, did not pass that zone, broke another structure, and respected that supply zone. It's kind of rough, but just follow my mouse and follow what I'm drawing. See, that supply zone held and price broke another structure to show that price is what price is has become bearish because price has started breaking structures to the downside. So price is now bearish. Now this is what I'm just telling you. After a break of structure for a bullish trend, we have supply zone. After a break of structure to the downside, after a break of structure to the upside, sorry, we have a demand zone. The last bearish candle, that is the demand zone. After a break of structure to the downside, the last bullish candle is the supply zone. Here is demand zone, here is supply zone. That is all you need to know. And this is what is known as market structure. Market structure is how market move as market is going up, how market is forming as market is going up, and how market is forming as market is going down. This is just basically it, what you need to know. Supply zone and demand zone as market is going up and as market is going down. Now this is just what, if you can know this thing, we can now move to other things you need to know. Some things like supply becomes demand, demand becomes supply, what's it called, inducement, fair value gap, and the rest. Because I don't want to make this video too long, and I want you to go to the chart and go and look for supply zone on any pair you want to choose. Go to tradingview.com. If you have a smartphone, you can download the app, download TradingView app on your maybe iPhone, or you download the TradingView app on the your Android phone. So just choose any pair. These are the pairs I trade: gold, Australian dollar USD, GBP USD, Euro USD, and GBP JPY. Just excuse me. All right. So for this example, and okay, let me tell you something about time frame. How market, as market is moving like this on this 30 minutes time frame, that's how market move on all time frames. Now what is it? What is time frame? Time frame is this thing you're seeing here. We have 5 minutes time frame, we have 15 minutes time frame, we have 30 minutes time frame, we have 45, and we have so on like that, all on to the even monthly time frame. This is the monthly time frame, this is the weekly time frame, this is the daily time frame. So this thing I'm drawing here for you happens on all these time frame. If we see a break of structure on the daily time frame, we can still go down to the 15 minutes time frame and we'll see the same break of structure. That is how market move. Market is dynamic in that way. So if we have known this stuff now, the next thing to do is just to know our fair value gap and inducement, and we can start taking trades. We can start taking trades. Now I'm going to stop here for now, and let me just ask if you have any question. If you have any question, if there's any other thing you want me to clarify for you concerning market structure, supply and demand zone, you can tell me. If we go to the daily time frame now, it's the same thing that is happening there. This is the daily time frame. The daily time frame means one candle here signifies a day, one day. You see, a single candle here means a whole full day. That's 24 hours. This long bearish candle now means one single day. This today, I think the last bearish candle that formed for GU, let me see. Okay, all right. So yeah, this is the last candle that formed for the day, for last week Friday. I mean last week from Monday to Friday. This is the single candle, and that candle was a bullish candle. It was a bullish candle. What does it mean? That price is bullish. Price was bullish on Friday. This one was the previous week, the previous day, sorry. So we have weekly candle also. This is the week, this is the weekly candle. This whole candle is Monday, Tuesday, Wednesday, Thursday, Friday candle. This small candle. But if you open this small candle now and you go to maybe 1 hour, then you'll be seeing all these are one hour candle, 1 hour candle, 1 hour candle, 1 hour candle. Now if we want to, because we are intraday trader, we will not be analyzing a whole week. We don't need a whole week. We just need what will happen right now and give us money. That's what we need, and that's why we'll only be working with 4 hours time frame down to 5 minutes time frame. So if you have any question for now, you can just ask me. You can ask me questions on market structure, supply and demand zone. If you don't have any question, maybe I'll just talk a little on fair value gap. I mean, supply becomes demand, demand becomes supply, and I'll leave the other ones for maybe our next class, which will happen next week, anytime next week. We'll talk to us to know when it's suitable for us to hold the next class again. All right, so if you have any question on market structure, break of structure, right, supply and demand, you can ask. But if you understand this class, then we'll move on to close for now and move on to the next topic next week.
Yeah, I
So,
have question. Good evening.
good evening.
Concerning this market structure, it can be very, very confusing. I swear. I've always it's like now you see this demand is confused about now.
Mm-hmm.
This your demand that nothing will come down. Sometimes you will start your trade, it will now come and hit that point. How would you know it will not hit that point? That's
Okay.
another mad one.
Okay. That's you just spoke because I know you have done trading once in a while. I mean you've done trade, you've traded, for a time. That's why you're speaking this way. Now that's why because I said that because when we are doing our analysis for intraday trading, we are starting from daily time frame. In fact, let's say okay, we are starting for weekly time frame. Now, this is I will teach you top down analysis, right? And you will see why when you mark your zone sometimes you know that market will not pass that particular demand zone or supply zone when we have done our markups. But then sometimes market will change, but it does not mean that that zone has failed because of this thing that I wanted to show you. I mean, this supply becomes demand, demand becomes supply. Where is that my markup now? It's at 30 minutes. Sorry, trying to. Okay, let me just draw that stuff again. So for the bullish trend,
Mm-hmm.
I will explain something to you now. Now for the bullish trend, when you see market will go up, come down. Sorry, comes down, goes up, comes down, comes down. Okay, just like this. Now this is a bullish trend, right? Market is going up and coming down, just like so. All these are break of structures to the upside, break of structures to the upside, and so forth and so on. Now, like I said, these are the demand zone where we expect price not to pass. The last bearish candle supposed to be our demand zone where price is not supposed to pass. But sometimes price, yes, price might go beyond that point. When we are looking at our lower time frame, sometimes price would go beyond that point and fail. But if we are looking at the higher time frame perspective and we are looking at like a daily time frame for instance, because we are doing if we are doing our top down analysis now, look at what happened here now. You see that price has broken this high for our daily time frame. Now where is our demand zone? Because price came down, right, and broke that high. The last bearish candle, just like I taught you guys, just like I just said now, is the demand zone for this daily candle. Now this is the demand zone, so we are expecting price not to go beyond that point. You understand? So as price is here, price is coming down. Price might be coming down here, and price will give a reaction here and go up. But sometimes, yes, price would go beyond it because of a higher time frame demand or supply zone. Now for instance, if we are trading on as an intraday trader, we are trading with 4 hours. We are not using daily time frame to mark our market structure, just like I did here. We don't mark I don't mark market structure using our daily time frame. You understand? I just mark um my daily point. I just know that okay, market is starting here today and I go to my 4 hours. When I go to my 4 hours, that's where I start marking break of structure and market movement. In fact, that's where it is advisable to be marking your break of structure. Now you see how market broke this structure. Market came down to this point. Okay, let me use here because market was even bullish. Market was very bullish. So market is coming from down here for our 4 hours. Market came from this point here, created a high, came down a little bit, and you see how market broke structure to the upside. You see that market did not come market has not cleared this point, has not cleared this low. This demand low is still holding because market came down to this point and broke another structure again even. You see that the first break of structure, I mean the first demand zone here is still, it was valid. That means the first demand zone held price to break another structure, and the second demand zone, which is this large candle here, this candle is very large. You see this very large candle. Now see what happened. Market has violated the candle. That's why when we are trading too, when market break the structure, we will see how market breaks the structure. See that this break is not entirely a break of structure. Let's look closely to that candle that caused that break of structure. You see, okay, let me use this one as example. When market broke this first structure, you see market broke the structure, gave a first candle, second candle, the third candle, and went high a little bit. But when market was breaking this structure, market did not create any other candle. It was just that same candle that broke the structure and market started coming down. This kind of break of structure is called a sweep kind of break, a sweep or a liquidity grab. So when you see this kind of break, there is every tendency that this demand zone might fail because market did not give an entire break to the upside, like totally. Market just stopped here. Market stopped here and started coming down this way. See, market started coming down. So this low might also be swept, which we saw here. Market swept the low and it's like it's going up again. You see what happened? But when it did this one, when it broke this one, it broke it upward. This is what is called the perfect break of structure. When you see this kind of break, you know that market would always respect this zone and start going up. But when you see a sweep kind of break, where you only see only one candle that caused the break, which is this bullish candle, and next thing you start seeing a down closing candle and market start coming down, you know that this other demand zone might not hold again. But then we'll still watch price to see price reaction around that zone. You understand? So this break of structure on our 4 hours time frame is not considered a complete break of structure to the bullish side. So it means that market might reverse a little bit. So I hope you understand. So when you are seeing a complete break of structure, you see market will break it entirely and go up a little bit, then come down to respect either this demand zone or this point. Let me just show you the supply becomes demand, demand becomes supply zones. So now if this is our demand zone, the last bearish candle for 4 hours, this is the last bearish candle for 4 hours. Sorry, this is the candle here. So now supply becomes demand means this candle here, let me mark it out for you. This is the candle, this bullish candle that you are seeing here. Just look at my mouse. This very bullish candle is a supply candle that failed to hold. You see that price, this candle now that came as price was coming up and down, price was price went up like this, came down. Automatically this place is now a supply zone. This place, when price now broke up here, this normally this supply zone supposed to hold, right? But market violated it and caused a complete break of structure. Now for us traders, this zone sometimes can also hold. It is known as a supply becomes demand zone, because it was a supply zone that failed, price would still come back to respect that zone and maybe give a continuation buy setup to the up. I took some trades that week to the up here because I know that if price respect that supply becomes demand zone, it will continue going up. Market structure, to finalize market structure talk, market structure is advisable to mark your market structure on the 4 hours time frame or the 2 hours time frame. Sometimes you can also mark it at the 1 hour time frame. Now, market structure will tell you market movement, where price is going to, so that you will know your next action, you will know what to do. If you don't know market, if you don't know how to mark your market structure, you have to know it, because that's what will tell you, okay, market is going up or market is going down, and we use the higher time frame to determine market movement, to determine price movement. So that is it. We use the higher time frame to determine it. So once you have known your market movement, the next thing to do is, well, I will not go into that, but just know that I will not go into that now. Maybe in our next class, I will not be telling you, after marking up your market structure, what to do next in your lower time frame. So as to take entries, you know, down to the top or down below. So for now, this is just what we are going to learn today. It's pretty easy and simple. The way I'm explaining it is pretty simple, because there are some classes you attend and you just maybe you they will just add one or two things and make things very complicated. But this is just basically it. I started with market structure because that is what you have to do when you want to trade. You have to know your structure first, where market is going to. If market is bullish or market is bearish, you have to know that first before you do any other thing, right? Just like here, market was, sorry, just like in this place now. Mm, let me expand it. So your business, you don't have any business with the weekly time frame. Okay, you might just do weekly time frame, but we don't use it to mark market structure because we trade intraday trading. So all you need is just to know your when you know your market movement, the next thing is to get your entry point and you take your orders to the top, or you get your entry point below, you take your orders to the down and you make money. So our market structure, you only use the 4 hours time frame, the 3 hours time frame, the 2 hours time frame, or the 1 hour time frame. See, these time frames are used to mark market structure. Once you get the direction of the market, then you can now go to these other time frames to take your entries. We are going to talk about entries on the next um class, I think. Yeah, we are going to talk about entries on the next class. So this zone now is the supply zone that failed. The last bullish candle here supposed to hold, but market violated it, went up and market came down. So this place is now, as supply becomes demand zone. In the future, price would come back there and react. Price might, in the future, you see price will just do this and you'll be sorry. Price might just do this in the future, come back here, react here, and go up. But with time, you will start understanding these things, how price move with time. When you start taking your entry, or when you start trading on demo and all that, you start knowing all these things, and your eye will become, you will now start understanding the chart, how the chart moves, when you continue to do it on a daily basis. But for now, just know that this is market structure and this is supply and demand zone. Supply zone is this zone here, demand zone is this zone here for bullish trend, supply zone is for bearish trend. So that is it. So okay, I've given you market example. So this is market example. This is a 4 hour market, which I've showed you. This is the demand zone for here. See how market price came down and mitigated the demand zone. If you look closely here, this candle dipped into this point here. Look at the candle. This is the wick. Okay, I think I'm going to talk about wick and body of the candle so that you don't get it, confused when I say wick sometimes. Now, what is a wick? Candle is made up of body and the wick. I'm zooming this thing so that you just see it. Let me delete this. All right, so this long black thing you are seeing here, okay, let me mark it from like this from here. Now in this bearish candle, this long thing you are seeing here is the candle wick. Why this one that is full, that is showing black here, is the body of the candle. So from here to this down here is the wick, of the candle. So if you hear me say wick, it means this very thing here, this long thing. If you hear me say body of the candle, this is the thing here. But as we move on further, I'll be using most of these terms for your understanding. So but while marking our supply and demand zone, we mark from the week to from week to week, so this is, if we are marking this thing now as the demand zone, we are marking from this last bearish candle, the wick of the candle here, to the wick of the candle here. So that is our demand zone. So that is, you see how price did not go beyond that point. And even when we extend this demand zone to this place, see how price still respected it and price was going up. You see price still came down here, respected that demand zone and gave a reaction and started going up again and started buying up again. So that is the power of using the higher time frame to mark your structure. When you get your structure on the higher time frame, you can now easily take trades and you can now easily know that price is going up or going down. Just like here now, as price broke this structure from here, we knew that this pair is now bullish. When price broke the structure up, we now know that this price is actually bullish. Sometimes as traders, we don't need to wait till price get to this point before we start buying. Sometimes as traders, we watch our supply becomes demand zone, because price can also react there. You see price can also react here and give us entry again to the upside while we are still anticipating this zone to still hold. So that is just basically it for market structure. Any other question? Any other question before we call it?
Now, for me, this is the first time I'm having experience of this. So I'm just doing screen recording. Maybe after we'll be going through it, because it feels like I'm not like capturing it like that, because I haven't had experience of this thing before.
Okay, no problem. I'm recording this video right now, and by the grace of God,
Okay, that's right.
and
That's right. Because
yes,
I will sit down and follow up.
if I also post this video, I also have other videos on my YouTube link, so you can also watch those videos. It will be giving you idea, because most of those videos I do top down analysis. What is top down analysis? We do analysis from daily time frame down to 5 minutes time frame, so as to get the market structure and direction of market. So if you watch those videos, I think you will still you understand what I just did here. You just understand it. Small will be there. We'll start taking trades and we'll start calling trades and we'll start making money. So that's just how it is. So this is just it. So
Okay. Is it the video on your YouTube page or?
no, it's on my YouTube page. I will upload this one. You can still watch other videos on my YouTube page. You understand?
Okay, that means you have to share us your YouTube this thing on WhatsApp.
Yes, I'll send it to you. After now, I'll send it to you.
Okay. Okay, that's nice. That's nice.
So I will also
Yeah.
communicate with you so that we would know when we'll hold our next class next week. Maybe within the week we'll hold another class. We'll refresh our memory on this one and go back to the new topic, which we are going to be talking about, fair value gap, inducement, range, and top-down analysis.
Okay, that's right. That's right.
Yeah, so I want to encourage you. This class is a free class, and practice makes perfect. Just as you've learned now, we have this site for to do analysis. This website, tradingview.com, you can see it on my screen. Tradingview.com. You can visit the site and go and learn how to open any of this pair here and just be doing practice. If you don't practice every time, you might not get it. So before we come back next week, just do practice. Enter 4 hours or 2 hours, start mapping out your demand zone and watch how market is reacting on those demand zone. Watch whether price respected that demand zone on 4 hours, or if price did not respect it. If price did not respect it and you do not understand what happened there, you can come and ask me question. Okay, price did not respect that zone, what happened? Then I'll now explain it to you why price did not respect that zone on your 4 hours time frame. If you see my slogan here, I said no flip, no entry. Go with the flow 30 minutes to 15 minutes. That is where I take my trade. After I've done my 4 hours analysis, I go to 30 minutes and 15 minutes and I take my trade. So I think we are going to end it here for today. If you have any other question, you can just chat me up on WhatsApp and I'll give it to you.
Okay, so thank you very much. Thank you.
All right. You're welcome.
So
Yeah.
much. Thank you.